Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. We've got a real-life market wizard joining us in the studio today. John Netto is going to be with us in just a moment. If you're not familiar with him, John is a successful event-driven trader. His proven track record earned him a feature in Jack Schwager's latest book, Unknown Market Wizards, the greatest traders you've never heard of. He's also written a few books of his own, including The Global Macro Edge and One Shot, One Kill Trading. It's going to be an awesome conversation, and I can't wait to get to know him a little more. But before we talk to John, it's Friday, the markets are closed, so let's take a quick look at how this week played out. It was a wild week between NVIDIA earnings on Wednesday and the Fed today, but we ended with a nice little rally on Friday. Overall, 2 of the 4 major indices closed higher this week. The NASDAQ led, gaining more than 1.5%. The S&P 500 also closed higher, rising about 80 basis points. The Russell 2000 and the Dow closed lower, but not by much. They slipped less than 0.5%. Now, taking a closer look at the S&P 500, it snapped a 3-week losing streak. We've been watching this 4,300 level for potential support during this pullback. That level represents last August highs, and we're holding nicely above it for now. If we can continue doing so, the next upside objective will be around 4,600. Those are the March 2022 highs. We were rejected there a few weeks ago, and that's where this whole pullback started. So that'll be the next task for the bulls to watch if we can continue holding this 4,300 level. Now, taking a quick look at sector performance this week, tech led for the second week in a row, gaining over 2%. And it's been really interesting to see tech leading like this while yields follow through to the upside. You'd expect tech to struggle with yields rising to multi-year highs like this, but that hasn't been the case at all. On the other hand, energy lagged, falling nearly 1.5%. Again, really interesting given what's going on with yields right now. Anyway, that's enough for me. Let's bring on John Netto. All right, John, welcome to San Diego, and welcome to the show, too.
It's great to be back. I was here 30 years ago for Marine Corps boot camp.
Oh, okay. Yeah, that's right. You started your career in the Marine Corps, right?
Yes.
And so, I mean, how did you make that road to becoming a trader?
Well, the first thing I had to do was get out of Marine Corps boot camp.
Yeah.
And between watching the planes fly off, which for those who have been in the Marine Corps, there's 2 boot camps out there. One is Parris Island, South Carolina, and then the other is San Diego, California. And I was 18, and after having spent a career as a liquidity provider for those wishing to prognosticate on the outcome of sporting events, I was a bookie in high school.
I was gonna say.
Yeah, I decided.
It's a very gracious way of saying that.
Well, we're all about euphemisms.
Yeah.
And so I decided to join the Marine Corps. It felt right, and I came here 30 years ago, and so it's great to be back.
Yeah, I mean, lovely place. Yeah, I moved here a couple of years ago. So you flew in this morning from Vegas, right?
Yes.
How long have you lived there?
I've lived in Las Vegas since 2004.
Oh, okay.
I spent time all over. I'm a native Californian, but Las Vegas is a city that appreciates the art of speculation.
Yes, it does. What's it like living there? I mean, it must be kind of crazy, no?
You think it's crazy, but there's actually an influx of Californians and people looking to implement what I would call dual state domiciles or opportunistic tax strategies. Because
Right.
If you live in Las Vegas versus live in California, there's a pretty dramatic difference on your state income tax bill, as in like a lot to none. And so there's a lot of Californians who are living in Las Vegas. And I might go down to the Strip. I live in the northwest part called Summerlin. And it's honestly, my daughter goes to school a couple blocks away. I have a great gym I work out at. I have a golden retriever.
Oh, nice.
I'm pretty domesticated.
What's his name?
Maple, her name.
Maple. Awesome.
Yeah.
Well, so listen, I don't know you. This is our first time meeting. Looking forward to getting to know a little bit more about you, and hopefully by the end of this, I'll know a ton about you. But how did you get started as a trader in the first place? Because you've had a pretty accomplished career so far.
Sure. I think I got started like most people, and that is by losing.
Right.
I got started
getting lucky at first, right? And then,
or maybe being unluckily lucky or being luckily unlucky,
right.
depending the journey. But I think it began, as I mentioned earlier, when I placed my first sports bet at the age of 8. And the idea that the rush that came from, the adrenaline that came from being a part of something that's unknown, and the outcome around that is at a primal level attracts a lot of us. And so at the age of 12, the Wall Street Journal had this article, and I saw the movie Wall Street with Michael Douglas and Charlie Sheen, and those lines from that still resonate with me to this day. So
what's your favorite line?
Greed is good.
Greed is good.
Well, so greed, for lack of a better word, is good.
Right.
Greed powers, greed motivates, greed inspires. And it was just, that moment, watching the final scene where they're on the New York Stock Exchange floor and Charlie Sheen's trying to do the right thing to save his dad's airline company, and just that adrenaline, that unknown, that cerebral engagement was why, even at the age of 12, I'm like, okay, I need to do things that help me with risk, and that's what led to my high school career as a bookie, but it did not lead to a great academic record. And so I joined the Marine Corps as a consequence.
I thought you were a pretty popular guy, though.
I was well known. I don't know how popular I was, but I was well known.
All right, so you started off kind of getting that trading bug or risk-taking bug,
right.
As a gambler in high school.
Right.
How did your training in the military kind of translate into trading? Are there any parallels there?
Sure. So something that doesn't get a lot of attention, Patrick, when it comes to trading, is that our DNA, our blueprint for how we feel about wealth and abundance is formed during our childhood. Okay, and so a lot of psychologists and people that look to understand like risk issues actually go back to look at a trader's childhood to see what their limitations are, what their beliefs are about themselves. Okay, and so for me, growing up, I had some serious self-esteem issues. I struggled with grades in high school, even though it was because I ran a gambling operation, but I never really got good grades. So for me, I struggled to believe that I actually was intelligent enough. Okay, am I smart enough to even do this? What possible edge can I provide on the markets? And so my early days of investing questioned myself as to whether I can actually succeed at this. And so the Marine Corps and the corresponding education I received from that helped me do that. And then over time, as I implemented these strategies, oftentimes with very painful losses, it helped me grow into experiencing that.
Oh, wow. And now you go to law school at night, right?
Right.
So what made you want to pursue your law degree?
So the legal system is ubiquitous in every aspect of our lives. The studio that we're in right now, when you go and buy something at lunch, politics we see on TV, just about everything comes back to some type of jurisprudential doctrine in the United States. Right. The Constitution controls so much what we do, and we see so much on Twitter and on social media. And the study of law and sort of this foundation, this philosophical and practical foundation that we live on, I just find absolutely fascinating. And once you understand these things and you appreciate the legal system, it just intensifies our enjoyment of life.
Yeah. And so I'm sure when you're sitting in classes, you must see a lot of parallels between the markets and what you're studying in law school. I mean, it's hard as a trader not to kind of draw those parallels in everyday life. So are there anything that you see, any similarities?
Absolutely, Patrick. Great question. So a lot of cases that actually make it to litigation hinge upon these nuggets of evidence that can twist the jury one way or the other, okay? What I found in trading is that it's oftentimes these discrete pieces of information, these nuances, these anomalies, those anomalous aspects are what can power a strategy to being robust or just marginal. Same way they can power a case to being decidedly in your favor to versus maybe a coin flip. And so that ability, that attention to detail, that desire to find out the evidence, that desire to find out research, and then appreciate that there are just variables that we simply can't control. You can't control how a witness is going to ultimately, testify, or there may be something that no one knew about that gets introduced later on. There could be legislation or regulation that comes into play that could change things. So the market has a lot of those as well. Maybe it could be a news bomb. It could be, something happens overnight in some cases. So the variables, the randomness, but nonetheless, though, both require a disciplined process that one must adhere to and then ultimately adapt based on the results.
Right. I guess, you're always weighing the evidence. That's something we talk about a lot.
Yeah.
And you're also always seeking the truth, right? Isn't that kind of what traders do, kind of with information, and also what you're doing as a lawyer too, right?
As a lawyer, you are representing your client zealously in many cases. And so the truth and how it gets depicted or how it gets conveyed, and then ultimately how that truth applies to law, is what you're hoping to do as an attorney for the best interest of your client. So the truth may not be, from one perspective, particularly favorable to your client, but in another perspective, as it applies to certain laws, could be less unfavorable, okay?
Yeah.
And so whereas in the market, it is a little more definite, like the market went up this amount, like that day, but your client did this, but what were the mitigating factors around that? You know,
Right.
and your job as an attorney can be to implement or at least introduce those mitigating factors to at least lessen the liability of your client.
Right.
Yeah.
I mean, like I was saying, quite an impressive career so far. And perhaps your biggest claim to fame is being profiled in the famous Jack Schwager book, Market Wizards. And, you know, that Market Wizards series, that's kind of one of those classic books for traders that they kind of make you read in trading kindergarten, right?
Yes.
So before we talk about Market Wizards, I want to ask you about that. But you've written several books yourself. One of your biggest ones is the Global Macro Edge. Is
Correct.
that-
Yes, Patrick.
So tell us a little bit more about that one.
Yeah, the Global Macro Edge may be the last book I ever write.
Why is that? Was it a grueling process, or?
It was a labor of love, and it started, I began it, I guess, the day I was born, but I began writing it formally in 2011 and finished in 2016. I spent 200 weekends. The book is 600 pages long. It's a tome, and it's my magnum opus, and it effectively memorializes the process of risking a little to make a lot. But it's called the Global Macro Edge, maximizing return per unit of risk. It's something that, Patrick, you and your viewers are familiar with, that we approach, many of us approach the markets from, I'm risking this to make that.
Right.
Okay, and that's something that the more mainstream media doesn't focus on.
Right.
They simply, okay, this stock is up that percent, that stock is down that percent, but it's not the context around it. So the Global Macro Edge not only helps us reassess or evolve our view of risk, but then what the processes are and how we can evaluate that risk, and ultimately how we can enforce that risk, so we can actually take an investment and measure against other investments on an apples to apples basis. Because if I give you, Patrick, $1 million and say, listen, here's $1 million, go and invest it, it's a lot different than me saying, hey, Patrick, over here, I'm going to give you $1 million, but if you lose 200 grand, I'm going to punch you out, I'm going to blow you out. So the Patrick that has no risk budget has a much different flexibility dynamic around how they can manage the position versus the Patrick over here that has a $200,000 risk budget or a 20% risk budget on top of it.
Right.
So the Global Macro Edge and what the Neto number does is help you measure those things so that now you're taking a three-dimensional approach. You now can actually look at performance, because let's face it, if I'm down money in a trade and there's a big drawdown in that account and then they make it back up again, that's a lot different than a slow and steady approach higher.
Right.
Especially if you know the risk budget around that.
Right. I like that focus on risk. You know, so many people want the secret sauce of trading, and a lot of it just comes down to the simple math of when you're wrong, you lose this much, and when you're right, you make this much. And you could tell someone that, but to really grasp it and to understand all the psychological hurdles that are associated with it and those hurdles that you have to get over, that's the challenge, right?
It is. And the issue with that, and you brought this up, it's a great point, is that you think that someone wants the secret sauce, but if you're not asking the right questions, which what the Neto number does and what the Global Macro Edge does in terms of helping you ask those right questions, is that if you're going to implement a strategy that actually had no risk budget and you can't actually measure how it performed against a risk budget, you could be putting yourself in a very precarious position financially, because when it does have its big drawdown, you didn't actually know how well that strategy managed risk around that.
Right.
And so what I encourage people to do is, with any investment, of course, map out a risk budget. What's your business budget? We all have budgets, or we should at least conceptually have constraints upon what we can do. So you should have constraints upon the investment, whether it's a real estate investment, whether it's you're investing in your child's education, whether you're investing time in something. Putting a budget around that and then comparing the performance relative to that budget, whether it's time, money, cooking, whatever the case may be, that's the question we should have. And that's why conceptually the Global Macro Edge has this evergreen aspect to it, and why I'll never write another book again, probably.
Could you tell us a little bit more about the Neto number? Is it like the Sharpe ratio? Does it measure volatility, or?
Oh, talk dirty to me, Patrick. Talk dirty to me, okay? So here's the situation. And I talk about this in the GME. There are three dimensions of risk assessment, okay? the first dimension is, what was your percentage return? Okay, and so Google made 10%, the S&P lost 2%, that's like dimension 1.
Right.
The Sharpe ratio, Sortino ratio are all dimension 2. They measure risk relative to the realized volatility. Okay, so we look at what the Sharpe ratio does. It will take the performance of a portfolio, it will factor in the past volatility that generated that performance.
Right.
Then there's the Neto number, which is the third dimension, and this is where it distinguishes itself from the Sharpe ratio and the Sortino ratio and the Kalmar ratio. It actually takes the implied ex ante or before the fact risk budget and incorporates that with the drawdown and the performance. So the difference is the Sharpe ratio doesn't have what the risk budget was. So here's why that matters. Because if I invest in a strategy and the guy took a ton of risk, let's say he was willing to risk 80% of his account, but he got low volatility, the Sharpe ratio can't grab that. So the Sharpe ratio can't grab how much risk was being actually taken. It only measures risk in terms of what the realized volatility was around that. So that's huge. So now you're an investor, you see that someone has a high Sharpe ratio, but you don't know what actual risk they took. It could have been a lot, it could have been a little. What the Neto number does is it measures the performance relative to that volatility and what they were actually risking. And that's the third dimension.
Wow, so it sounds like the Neto number would be a great benchmark to judge a fund manager's performance, select whether or not you want them managing their money. Is that kind of one of the more better use cases for it?
You're pretty good at this, Patrick. You can do this for a living.
So that's it?
It is. It absolutely is. And not only that, you can take it and put it on market. So I can compare the Neto number of the S&P versus the Neto number of Google versus the Neto number of a real estate investment. I can even putting it past just the markets, you can put a Neto number for a car salesman. What's a car salesman's Neto number based on the amount of traffic they get versus the sales area versus the cars they sell?
You can calculate something like that?
Absolutely.
Oh, wow.
You can do Neto number for a real estate agent. What should, so here's an example I'll apply to real estate. I talk about this in the book, okay? Real estate agents typically make 6% commission on what they sell a house for, okay? When a real estate agent goes to a prospective client and they want to get the listing, do you think most agents embellish a little bit about what price they can get for the home in order to get that? Okay, so what if you use the Neto number to actually give the real estate agent his commission based on the sale of the home? Meaning, okay, that's fine. If you think I could get $1 million for this house, we're going to pay your commission based on the Neto number. So what are the two most important things when you sell your home? One, the price, and two, how fast you sell it. Okay, so we'll take the time and the price, we'll put a Neto number on that and put that into a formula, which then you could pay the real estate agent a commission. Guess what? If he sells it fast for a high price, he gets a higher commission. If he sells it below the price he assigned to it at the listing, and he takes a long time, he gets a much lower commission. So now you're holding him accountable with a pre-approved three-dimensional metric that incorporates both time and price into the sale of the home.
Right, so it incorporates those two key metrics, whether we're talking about real
Correct.
estate or
because
market.
You would agree that if you get a great price, but you're willing to wait a while, that's okay.
Yeah.
But if you get a great price, but you get it soon, that's really something special.
Right.
And accordingly, if the agent does a good job, he should receive a higher compensation. However, if you get a low price, you had to wait a long time, should that person get the same commission as the agent?
Probably not.
Probably not.
Right.
Okay.
So I want to ask you about Market Wizards now. What an honor that is to be profiled by Jack Schwager like that. And so tell us, how did that come about? Did he reach out to you, or?
Yeah, it's quite a story. So Jack Schwager is a super pioneer author. He created a website called fundseeder.net. And fundseeder.net wanted to bring transparency and accountability to traders out there and acknowledge the fact that there's a lot of great traders that may not come from New York institutional backgrounds, but still have unique strategies, albeit some of them may be capacity constrained, that they can still provide value. So Jack Schwager and some others built fundseeder.net, and for a number of years, I had my returns from my futures account sent directly from the FCM or from the broker to Jack Schwager's website.
Is that how the website was set up, to be verified like that?
Exactly, to be verified. Okay. So there's third-party verification, so that you can have people verify the performance of these traders, because people can say whatever, but having a third-party site that actually gets the statements from the brokers directly adds a level of transparency and credibility to the talent assessment.
Absolutely, yeah.
So I did that, and I think for 6 years or 7 years, he received my statements, and after 7 years, my account was one of the top performing accounts there, and he called me and asked me to feature me in his upcoming book, Unknown Market Wizards, which came out in November 2020. And he called me and he flew into Las Vegas for 2 full days. back in August of 2019, because there's a lead time on this book between myself and the others.
That was a weird time for the world.
That was a weird time. August 2019 was a weird time for the world, and it changed quite a bit between when the book finally came out, a year later, obviously. So August 2019, he comes in. We must have spent 7 or 8 hours that day. He's incredibly judicious, very pedantic, very detailed, very just a phenomenal. He will not let the integrity of his books be compromised if your performance isn't there. He drills down on, he wants to know every little nuance. He fastidiously protects the integrity of his books to make sure that there is no one in there that's not truly delivering the performance that's being represented.
Wow, was it intimidating? Like, it sounds like he had everything prepared.
And I'm like, bring it on. You know, if anything, it was like, I got to get back to the markets, Jack. Come on, I got to trade. You know what I mean? And so we did a 7 or 8 hour interview one day.
At your home in Vegas?
In my home in Vegas.
Okay.
He came to my house. He saw my whole setup. Saw what I did, and then we did a follow up interview 4 or 5 weeks later. And then something that he does, which is totally fair, is he lets you look over it and get a sense, because there could be material facts that are incorrectly conveyed or articulated. So he makes sure that there's no immaterial something that's not materially inaccurate ends up being in there, which is completely reasonable. And then from there, you rock and roll and you go from there. And he asked me about my time in law school, because at that point in time I was at Pepperdine doing the master's program, doing the master's of legal studies. And so we incorporated a lot. And he joked in the intro paragraph that it was kind of a spaghetti bowl, because as you may be able to tell, I tend to I can go off on tangents quite easy. And so that tangential conversational aspect was part of the interview.
Oh, wow, that's amazing. So I want to get into your strategy a little bit more. Sure. And without giving away too much of the secret sauce, could you give us an overview of how you look at markets?
Sure. So the global macro edge, maximizing return per unit of risk, plays upon a marriage of technicals, which are critically important because they provide the manifestation of these beliefs and thoughts in price action.
Right.
Okay. Along with pre-identified, or at least currently identified, what narrative is pushing around that manifestation. Okay. And so in my case, what Jack Schwager interviewed me about and what's at play is how I trade economic events and through an upcoming product called Event Trader Pro. And what I'm looking to do in the global macro edge is I'm looking to risk a little to make a lot. So what do we do then? We identify market periods where the market could potentially go through a reprice or what's called a regime change. And so in order to identify a regime change, we need to know what actual regime we're in. What's the current market environment? Is the market environment focused on the Fed? Is it focused on economic data? Is it focused on earnings? And so,
what is that kind of big ticket item?
Right,
What is the market worried about?
Right. And what are supplementary items that can either support that on either a short-term basis or even longer-term basis? Okay. So there's major themes and there's also sub-themes and subplots, which based on market liquidity, et cetera, can also push themes around as well. And so the strategy which I built software around, et cetera, identifies these events in advance. So it could be a CPI, it could be a Fed event, it could be a grain report, it could be an energy announcement. And we know that these events, there's ample empirical evidence that these events allow us to where the market could go through a repricing. And so then the next question becomes, well then what aspects of that event will then cause the repricing? What aspects of that event will the market regard as relevant or material to that repricing? And so that's where a lot of the qualitative art comes in, of assessing, okay, the market is more focused on this right now, or it's less focused on this right now, but that still can be technically deduced as well.
Right. And so it sounds like you're very short term, is that right?
Yeah, no, that's a fair assessment, but there are situations that can lend longer term. So let's define short term. So in many cases, these positions from the strategy, and experience that I've had is that you're in for less than even an hour. It could be 5 minutes, 15 minutes, 30 minutes, and you're done. The trade is over.
Just flipping it.
You're flipping it, yeah. And then you're in cash for the rest of the time, which has its appeal in terms of how you can allocate that cash when you're not in these strategies, and how you can gear a strategy based around a balance sheet.
Sure. I mean, way less opportunity cost, right?
Dramatically less opportunity, or what should be less opportunity cost. You are, of course, for those disparate pockets, increasing volatility at an exponential order in that regard, because you're seeing 1%, 2%, 3% moves in 1 minute in your account. If you expand that, you know what I mean, even logarithmically, there's still that's quite an outsized return.
I see what you mean. Yeah. It kind of gets back to that Neto number, right?
It does. And so these strategies say, okay, I can in this period of time, using intraday leverage, find situations where the handful of times that there's possible trend change in events, the market simply can't adapt fast enough to that. And so that's where having an understanding of the macro narrative on top of price action, using technical support or technical price data to help support that comes into play.
And what instruments are you trading? Futures, ETFs,
A lot
options,
of futures,
anything?
Yeah, almost exclusively futures, but this can be applied to ETFs, stocks, single name issues, et cetera, which naturally, I mean, we all know, or most of us are familiar with just how top heavy these indexes are now,
right,
led by tech. And so, you know, when the CPI comes out, you know, or when an economic data comes out that can influence Fed policy, you know, we're going to get these big names moving on that just because of their representation of the overall indexes.
Right.
But also I trade things like, you know, fixed income. I trade the grain numbers, you know, corn, wheat, soybeans, soy meal. I trade crude oil. I trade natural gas. I trade the crack spread. So like I've built, you know, I'm not just an event trader per se, but I'm someone who's built strategies and has worked with news organizations in the past and have built these strategies to help identify blind spots in portfolios. So even if you're not trading these actively, if you know that there's a blind spot coming up potentially, you can at least go to cash and then be aware that, okay, this event's now passed. Nothing fundamentally that can alter the market has changed. Now I can resume the position, or I can take off some of that would have led to excess volatility.
Right. So it sounds like you're very in tune with the macro environment, obviously, and the fundamentals, but here at the Chart Report, we love our technicals. So could you just speak a little bit more about how you incorporate technicals into your process and the role technicals play?
Sure. So my first book, One Shot, One Kill Trading, was exclusively a book about technicals.
Okay.
So technicals I began and cut my teeth with and still use actively to this day because you have a narrative, but ultimately price has to manifest itself.
Right.
Okay.
And a lot of the times the narrative comes about because price did something.
There's
right?
a reflexive aspect for sure.
Right.
And so technicals come into play where they always come into play, and this is where we can have an interesting discussion about this, because one thing that I chart, all right, is implied volatility, okay? And so I ask you a question. Is incorporating implied volatility a technical or fundamental question? If you can chart the VIX, I think it's a technical question.
Yeah, I'd say
I think it falls under technical analysis.
But then again, I say everything's
right.
technical. But
So fair enough.
Yeah.
So if you have implied volatility, which is spiking, okay, well then, and you overlay that on top of a chart, and you get a breakout, that's a different analysis than just looking at a chart by itself, because you're using supportive indicators to map that out.
Yeah.
So I think we're having kind of the same conversation, albeit I incorporate and proudly incorporate a qualitative aspect of the narrative, but it still rests and manifests itself on a number of incidental indicators or separate indicators, which are not necessarily in the chart itself, but like implied volatility is not going to be in the chart per se, but knowing that implied volatility is high, as you can chart that out, helps you on a single stock overlay that and still keep it pictorial or visual.
right. So it almost confirms, it's
Correct.
the confirmation mechanism to everything else you're doing.
It's at least supporting in that regard. So it's another input. It's another factor in the model.
I see.
Okay. So just how we analyze that model is, I think, why you can bring the show together, because we can all incorporate different technical aspects,
Right.
but the way that we assimilate those or synthesize those is what's at play.
Yeah. And you know, it's very rare to see a very successful day trader these days. I think it's kind of a dying breed. Would you agree with that, or?
I think the nature of algorithmic trading and how things have evolved have just made trading's always been tough.
Right.
Okay. it's 5 years ago, 10 years. I've been at this game a little while. It's always been
It's almost like a dirty word now to say you're a day trader. It's almost like, oh, okay. It has this like negative connotation with it, where it didn't really before. Would you agree with that or disagree? I mean, you don't.
I don't disagree that there's a pejorative connotation around it. I think the response is that I'm temporally opportunistic. Okay, and so I look at time frames that are conducive to risking a little to make a lot.
Right.
If that's a 5-minute time frame or a 5-day time frame, I'm agnostic to that. But there are benefits that are exogenous benefits by being a day trader that we can use, that people who are not day traders, people who are not so temporally opportunistic, can take advantage of.
Temporally opportunistic.
Yeah.
I like that.
That's what law school does to me.
Now, will you take positions over the weekend, overnight?
If appropriate, but there's lots of ways to structure that through options. So I believe a lot in option structuring, because it's all about defining risk. Because if you're going to maximize return per unit of risk, what do you have to do? You have to define what your risk is.
Right.
And more than define what your risk is,
And how do you really define
how do you measure that
Right.
risk then? How do you control that risk? So you can quantify it, but can you control it?
Right.
So options and the structures help me control it.
Right.
I'm typically an option.
It can be tough with a stop loss. Is that what you're kind of getting at?
Yeah, at times it can be tough with a stop loss, and you can get you can get a lot of gamma in the markets, but maybe not a lot of delta. So there's a lot of whip, but the market doesn't go anywhere.
Yeah.
So by having the right option structure, you can avoid from maybe being prematurely exited when the trade is still viable. And that's one of the things traders face.
Yeah, and I guess you can know exactly how much you're risking, right?
Yeah.
Whereas stop, like I was saying, there's slippage, there's stuff, what if it gaps down and you have to liquidate at the open or something?
Sure.
So there's all those problems. But, I can't think of a better week to have an event-driven trader like yourself here to talk about this on the show, because we had a big week of events, right? The whole week, the market was kind of holding its breath for two big events, and the first one being NVIDIA out on Wednesday, and the second being Jackson Hole. We had Powell coming out and speaking today on Friday. So I'm wondering, let's take the Fed, right?
Okay.
So
that's what I do. That's my jam.
Okay. What in particular are you watching, using today as an example, using Jackson Hole?
Sure. I mean, Powell came out at Jackson Hole, and there were no particular surprises. Some people thought maybe he might give some foreshadow possible interest rate cuts, but the Fed is remaining very consistent. Powell altered their message in November of 2021 when they lost a ton of credibility because it was a week after he was reconfirmed for another 4 years, and now all of a sudden after inflation, we're not even thinking about raising rates. Turned into inflation's a real problem, and they just started the pedal to the metal and whatever 4 straight 75 basis point hikes
in like
later.
a year too.
In a year,
it went from doesn't matter at all. We're not thinking about it.
Complete loss of institutional credibility. Okay, just really bad. So, but since that loss of institutional credibility, they've been very consistent. They have not backed off. They have not wavered on what they're going to do. And the market has had to come to the Fed, not the Fed come to the market. And so if you analyze, 15 or 20 years of Fed funds pricing history, and you see, that the market's always sort of had this Fed discount in, where the Fed funds have been priced below where the Fed has projected the Fed funds pricing. That's not been the case in the last year. The market's had to come up and almost kicking and screaming to where this is at. And we've seen, treasuries the last couple of days preceding the Powell speech the Powell speech from Jackson Hole actually rallied a little bit, but some of that is squaring on what's otherwise been a very tough August for interest rates and for precious metals like gold, which has actually kind of taken on a lot of price simulators to the 2-year Treasury yield. And we're seeing from Jackson Hole that not much change. Powell is staying consistent. Rates are going to stay here for a while. They need to beat inflation. Not being vigilant against inflation has caused a lot of problems historically. And so Powell's more like Volcker than he is like Bernanke. Okay? And Bernanke, who was a Fed chief, obviously, who studied the Great Depression and said the Fed didn't do enough. And a lot of people thought that Powell was sort of patterned after the Yellen-Bernanke model, and Powell's actually done a complete flip. And he's now patterned very much after the Volcker model, and higher for longer and whatever it takes, even if it means inducing a recession. So that's a whole different school of thought, discipline-wise, doctrinally, that we see from the Fed now.
Yeah, it seems like he is trying to play that Volcker role a little bit. Not Volcker rule, totally different thing. But it sounds like you're very in tune with the narrative and what's going on in the news, but also looking at the market's reaction to it, right? And looking for the market to confirm it, or how the market is interpreting these events, right? And that's kind of one piece of the edge is really being in tune to that, right?
It's a huge piece of the edge.
Yeah.
It's the global macro edge.
But it's not easy to do, right? I mean, we could say, oh, you got to listen to the market, but what does that mean, right?
A lot of things to a lot of people.
Right. Yeah, right.
For me, a lot of it, and this gets downplayed and it's almost like taboo, but I think intuition is huge. And intuition is the manifestation of the analysis performed by our subconscious. And I encourage people to trust your intuition.
Absolutely.
And it's about where it comes from. Like when you are analyzing that, where are you personally?
Yeah.
Are you in a good place? Are you coming from desperation? Are you relaxed? Are you calm? Are you using the prefrontal cortex of your brain? Or are you desperate in the amygdala part of your brain, which is the fight, flight, or freeze part of your brain?
Right.
And so I think some of the advancements we have are neurologically, where are we at? What do we know about human psyche? What do we know about how the human brain works, okay? And I think that for as effective as technical analysis is, we should be spending a commensurate amount of time, or at least a relative amount of time, analyzing ourselves.
Yeah.
And what our belief systems are, and how those belief systems impact the way we look at strategies, the way we manage trades. Because there's a lot of objective information out there that could help us trade better, but how we ultimately execute that and under pressure, which all of us, when we trade, come under pressure.
Right.
And how does that pressure affect our decision making?
I think that's really, I had a question about how psychology kind of plays into it, so I'm glad you went there. And I really like what you said about intuition there, because I remember years ago, there's a guy named Aaron Brown. He's a well-known mathematician. I don't know if you've heard of him. He was also a professional poker player too, but he was the head of risk management for AQR, huge hedge fund, right? He's not there anymore, but he's retired. But he said something, I went to a conversation about the parallels between trading and poker or gambling, right?
I love poker, by the way. Yeah,
right. You would have loved this conversation.
Yeah.
But he said something I'll never forget. He said, you know, everyone wants to say computers are the smartest things out there, but people don't give enough credit to human intuition, right? Sure. If I showed a picture of a cat to a computer and said, what is this? It would have to go through a series of logical processes to determine it's a cat, right? If I showed you a picture of a cat and I said, John, what is this?
Fluffy.
Right. You would say a cat, and if I said, well, why? You would look at me like I had 4 heads, and you'd be like, because it's a cat, right?
Right.
But that's where intuition comes in, right? You don't even know. I mean, it's these subconscious processes that are going through your head where you don't have to really think about it. You just know what you're seeing, right? And the same thing goes in the markets, right? When you see a certain kind of reaction, you know what's going on. You can kind of read it that way.
You're largely confident. I mean, we never know from an absolute perspective, which is what we respect things, because there still is randomness and variables at play that do that. But I journal quite a bit about my market stuff, and I encourage people to do that as well, because our emotions that we have, I think, are quite comparable to the way other people feel. That feeling of desperation, the feeling of being frightened, the feeling of being greedy, the feeling the feeling of complacency. Not that they match like for like with everyone, but we as human beings are kind of wired about the same way.
Right.
And I think that our emotional barometer of things could be instructive in terms of how others may be feeling as well. It can be instructive.
Right.
So it's another thing I try and pay attention to is people's internal emotional barometer.
Right. And I guess that comes with experience. But what about earnings? You know, I had mentioned NVIDIA's earnings earlier. Are you ever trading earnings results, or is that?
That's not my first foray, but that's something I pay attention to because it does influence the broader markets, which has a huge macro effect on it.
Right.
So obviously NVIDIA in their blowout, but it's interesting the subsequent reaction to that, you know, and what that means and just how much juice is in there. But you know, earnings provide another opportunity as well, because you have revenues, you have profits, you have anticipated profits, anticipated revenues, the sequential growth or decline of those corresponding numbers. And so they provide a lot of ways to provide a score, a synthetic score around what that does, which is a little bit about what Event Trader Pro does, is it gives people a score and assessment that they can look at. So you don't need to be a Fed chief to benefit from my perspective of the market, because it does, the Event Trader Pro will provide that for you in multiple layers, from both a newsletter that highlights the event to the subsequent analysis that comes out literally shortly after the event comes out. And so I think a lot of us, it's not about you knowing everything about everything, but it's about knowing who you need to lean on when it comes to certain things. And if you could build that ecosystem, if you could find something that expands and empowers that ecosystem, you're probably going to put yourself in a better spot to make money.
I see. I like it. Well, John, I think we got to wrap it up here. I could pick your brain all day. But before you go, tell our viewers where they can find more of your work if they're interested.
Well, first of all, Patrick, it's been great being with you. I love being with a fellow technician. It's near and dear to my heart. People want to learn more about me, you can follow me on Twitter at John Netto, at JOHNNETTO. We have some amazing products coming out here, working with the group here, and I'm excited about those, and everyone will hear about that coming very soon.
Awesome. Well, thanks again for coming on, and I hope to stay in touch.
Fist bump.
Yeah, cheers. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.